Hello, 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 everyone. Happy sipping well time. So, yes, I know I am midday, so I'm going to get quite a few of you watching the replay of this. I'll also screen the replay in the Sipping Wealth group this evening as well at 7 p.m. for those of you that missed this time. But thank you for joining me for another episode of Sipping Wealth Live. Today I'm going over some tax tips, 10 tax strategies that you can implement, some of them even before the year is out. And then also some tax strategies that you can make sure that you are implementing in 2024 so that you can maximize your tax savings. So my name is Wadleen Charles. I am your accountant, your lovely accountant and wealth coach. I am here to make sure that you are educated, that you continue to expand your mind, look at these financial tips, look at these tax information as well, so that you can live your best wealthy life. So those of you that are tuned in with me, go ahead and, drop a hate in the comment section. Let me know that you're tuning in with me. I see a couple of you are with me. I don't know which platform though. It just kind of shows a number. But yeah, let me know who's tuned in. Drop a comment in the comment section. Also, while I'm speaking, if you do have questions, be sure to just go ahead and drop them in the comment section. I'm going to go ahead and jump into the topic. I don't want to take up too much of your time, and I also want to make sure that those of you that are coming on after the live can watch the replay and get these gems. Also, one other thing, make sure that you are sharing this information with your friends and family because we want them to wealth up as well. All right, so for our first strategy, y'all. Okay, first strategy, I really want to dive into essentially kind of like the basics as far as the deductions and how they work. Some people, they're like, oh, they expect write-offs to mean that they're getting the money back. So I want to put that out there, like write-off doesn't mean you swipe it on your business card and then the IRS pays you back the money you spent. Now it means that, hey, I can use it to deduct from my taxable income. So it just decreases my taxable income. It's not a dollar for dollar on your tax bill. So, but it does decrease the taxable income. So above the line. All right. So when you have your tax credits, those actually decrease your tax bill dollar for dollar. Okay. All right. So first tip is kind of knowing your deductions. So knowing that, hey, you have that gig work. If you're a 1099, maybe you do Uber, maybe you do Lyft, maybe you do things on the side, a hobby, and you get paid for it. Maybe you bake cookies and people pay you for your cookies, or you have a business, right? So if you do that, maybe you have a home office. I want you to make sure that you take advantage of these deductions, home office deduction. If you do not have a physical location where you work out of, and you actually work out of your home office for your business, then you could deduct that square footage. So from whatever that square footage of that room is, everything associated with it. So you're gonna take the percentage. Maybe my home office is 10% of my home, 10% of my light bill, 10% of everything that's associated with the general expenses of my home is a home deduction write-off. So that's a huge write-off that a lot of people negate and don't take advantage of. Also, education expenses, maybe for professional development. Maybe you have to do continuing education, or maybe you have to purchase some books, get your knowledge up on a particular area within your business. That's a write-off as well. Travel costs. And then this is another tip as well. So with travel costs, how to effectively deduct your travel costs. Maybe you want to do one of the days throughout your business travel. Maybe you want to have a personal day or something like that. And how do you go about deducting the entire trip essentially? So you want to when you do so, maybe you go to a conference that starts on Wednesday And then you also have to stay through the weekend, and then you have to continue on the conference the next week on Monday the next week, or up until Tuesday the next week, or whatever business trip you have. Maybe you're going to look for real estate property, something like that. And you can actually go ahead and write off that entire itinerary, because the IRS is like, you don't have to fly back home, then fly again just because you have to do business again on Monday and Tuesday. Okay, so that's all the travel expense costs. All right, the other one is research and development. Research and development is a tax credit. So this is dollar for dollar decreasing that tax bill. And this is a tax credit that actually doesn't get used enough. A lot of the times they get used by larger companies, maybe even people that are more established, things like that. But a lot of people negate using this R&D and research and development credit. And this is businesses that are investing in innovation, maybe software to improve a particular product or their processes. This can be a huge credit. And if you need any assistance on either of these, feel free to reach out to us and book a strategy session. All right, the other is income splitting techniques. So when you are, maybe you are, maybe you have a family member that is also assisting in the business. You want to make sure that they are also that you're not just giving them the money. If they are a pivotal part of the company, or if they're actually adding to the company, you want to make sure that you have them on payroll. Maybe you are paying out dividends to the family member. Maybe you are paying out some share of income to them, or maybe even setting up a family trust. But you want to make sure that you're setting up some kind of, like other source, so that you can spread that tax burden. So now, instead of being taxed at a 37% tax bracket, you're being taxed lower because you did this income splitting technique. So you want to make sure that you're paying out those family trusts. You want to make sure you have these different things in place. So, and this helps tremendously, especially as you build your wealth. And if you're getting hit with those tax bills and you're like, oh my gosh, these taxes are kicking my butt, this could definitely help. All right, the next one is, and I know I'm flying on these, but this is great stuff. Okay, the next one is a health savings account. Y'all, so these HSAs do not get used enough. Like, this is a huge tax benefit. This is money that you can put into this account. The money doesn't go away. It could just sit there. As you know, medical bills and expenses increase as you age. So you can utilize this money tax-free to go towards your health costs. That's premiums, that's co-pays, things like that. So this could help with things that expenses that you already have, and you're paying it with tax-free dollars. Okay, the other is the education savings account. You have your retirement accounts, 401k IRAs. We could go on for days about retirement accounts, and I'll have a separate live going for retirement. I know we don't have all that time for me to go ham on it, but retirement is definitely huge. Again, if y'all do have questions, let me know. Okay. All right. Okay. The other is your charitable contributions. Ooh, I don't know what's going on with the computer. Okay. All right. I don't know what happened. Okay, y'all. So, charitable contributions. All right. So, with the charitable contributions, if you're doing, and not your traditional, oh, I'm going to donate clothes, oh, I'm going to donate some money to the local church, but you can actually donate other things as well. You can donate stocks in your company instead of donating cash. You can also make charitable distributions from your IRA account. That's another thing as well. So you don't have to do the traditional cash to the church or cash to wherever you're donating to. There are different options on donating as well. All right. The other one I'm going to mention today is the 1031 exchange. And this is for my people that have real estate, or it's a 1031 exchange is for the as a like kind exchange. So primarily used for those that are in real estate to offset essentially the rental income, depreciate to offset that depreciation, recapture income from the sale, things like that, capital gains. So when you're doing so, you're essentially saying instead of selling that property and taking all the income and walking away with a tax bill from it, maybe it was an investment property and not your primary resident, so you don't get that home exclusion credit deduction. But this is maybe another property that you have. You go ahead and sell it. Now you have to pay capital gains tax on 200K. But within that process, you can actually say, hey, instead of walking away with the 200K, I want to essentially use that money to purchase another property, or use that money to purchase something similar to that property that I sold. So this is how to offset that capital gains. This is how they kind of funnel that and how they're going. And you can literally have this keeps rolling and going on forever, right? So you can, maybe you have your first house, your starter home, and then you're like, oh, I'm going to keep my starter home and purchase somewhere else, and you turn your starter home into an investment property, and now you're like, oh, I'm going to sell my starter home and purchase another property. That starter home was 150. You sold the starter home, you purchased another one for 200K. Then you sold the 200K property, you purchase another one for 400. Because as you do that, the bank is like, oh, you have something secure, real estate to back this loan, and you've been doing this, so you have more trust from the financial institution, the lender. So going from a $200,000 property to now saying, hey, I now qualify for a 400K. I now qualify for a 700K property. I now qualify from 700 to $1 million property. And you can keep essentially doing this 1031 exchange. It just has to be a like kind, a similar area. The other is, let me just take a sip of water, y'all. I'm a little dehydrated. Okay. So one of the big ones is S Corp. I hear it mentioned a lot. I know I speak to my clients about it a lot. So when do you consider the S Corp conversion? Before I even get into that, ultimately making sure that your business is structured properly is so important. So whether you're like, hey, how can I properly structure this partnership deal? How can I structure, I want multiple LLCs, I want a holding company, I want to do this and that. So when you're sitting down and you're trying to come up with, or what this is going to look like in the end game, or what this is going to look like, what do I want my financial house to look like? You want to kind of build that out. And whenever I start with a new advisory client, I make sure that I build them out this essentially a roadmap. It's a picture, a big picture, and it's going to put, hey, where they're at, where do they want to be, so that we can make sure that their assets properly align, or in the right places, so that they can funnel what they have to, so that they can facilitate what they want to essentially accomplish in the long run. All right, so S Corp, back to this. So when do you consider an S Corp? If you are doing a net income of 50, 100K, imagine making a net income. This is after expenses. After expenses, imagine making an income or generating 100K in revenue and saying, oh, not only do you have to pay income tax on that, you also are getting hit with 15.3% in self-employment tax. That's an additional $15,000 in self-employment tax that you have to pay because of your entity structure. And why that is because a sole proprietor, even like partnerships on a simple partnership level, and a sole member LLC, you're seen as being self-employed. So when you are self-employed, you have to pay the employer and the employee portion of the payroll taxes. You are not employed, you're self-employed. So that's what that 15.3% is. So a lot of people get hit with this and they're like, oh my gosh, I have to put away 30% of the income coming in my business for taxes alone because I'm getting hit with self-employment tax as well. So I have to, count that 15% plus an additional 15% in just self-employment tax. Now I got to put away 30% of the income. Or maybe you're at a 32% tax bracket and you're having to put even more away. Knowing, hey, when's the right time to go ahead and convert your entity structure is absolutely important. All right. And the last one I'm going to cover is going to be estate planning. And considering the uh, uh, instilling a trust or creating a trust or even a gifting strategy within your financial house, your wealth house, however you want to look at it. So a gifting strategy, how you're going to spread money across or give money or assets to your family members. How you go about doing that without getting hit with a huge tax burden. When should you implement that trust? Hey, life insurance. People really negate the power of life insurance and how important it is and how useful it is when building your financial house. And not only can you leverage the policy, you can also huge leverage, by the way. Some even business loans require you to even have a life insurance policy to even get a business loan because they want to make sure that even after you're gone, they're getting their money too, right? But it's huge leverage with this life insurance, and it also helps with your overall estate planning and minimizing the tax burden as well. You can have policies within your business, key persons policy, things like that. There are different ways of implementing it, even in your business and on a personal end, regardless of how you put in the life insurance structure, it is going to be beneficial to you. And it can be a huge tax savings in the long run, and maybe even in the short run if you're at this point where you're ready to put that into a business structure of yours, right? All right, let me make sure I'm having questions, y'all. Questions. Make sure I touched on all of them. Any questions? All right. Okay. All right, if that's it. So to recap what I've gone over as far as the tips, making sure that you take advantage of those deductions as a gig worker, as a small business owner, as make sure you do those home office deductions, those education expenses, things like that. Also, the other is the R&D tax credit, research and development tax credit, taking advantage of that. If you do have any products or softwares or things like that you're developing. The other is the income splitting technique, paying out dividends, maybe setting up a trust, a family management company, things like that. The other is a HSA account, setting up an HSA health savings account that's tax-free dollars that you can utilize to pay towards your medical expenses, retirement accounts as well. So utilizing that Roth IRA, maxing out that Roth IRA while you can. If your income is steadily increasing, then you want to max out your Roth IRA while you can, because after a certain level, you're going to either have to do a backdoor conversion, or you're going to have to, or backdoor Roth, I should say, or you're going to have to just do the traditional route because you're going to phase out. All right. The other is the charitable contributions, setting up charitable contributions outside of doing your traditional cash contributions. Maybe you could do a stock instead of cash. Maybe you can do the IRA route, qualified charitable distributions from the IRA account. All right. The other is your real estate 1031 exchange for those that are looking to not to mitigate that capital gains tax. Just go ahead and purchase our next property, but make sure that there is a time limit as far as how long you can take to look for the next property. So you want to make sure that you already have the next property in the pipeline. All right, before you sell. The other is making sure that you have your business entity structured properly, because it could make or hurt your tax, your tax bill. And then C corps, you know, a lot of people just jump and create a corporation because they think it's gonna make them super separate from their business. I just want everything separated. Y'all, it's a huge tax burden for you. Like a lot of times, unless you're planning on going public, C corp is generally not the way to go. All right, and the other is estate planning, life insurance, and utilizing life insurance and your wealth planning and your tax saving strategy as well. All right, y'all. So that is it. Let me make sure. If y'all do have any questions after I post a live, be sure to drop them in the comment section. Book a call with us at Strategic Tax Accountants, and that's on all social media platforms, Strategic Tax Accountant, or you can go directly to our website, strategictaxaccountant.com, and you can book your call. We do free 15-minute consultations. That's really like a discovery call, seeing what your concerns are, and then we can point you in the direction of doing a strategy session or whatever other services that you're needing. If you want a list of our services, go ahead and head over to the website. And then Sipping Wealth on all social media platforms as well. Sipping Wealth on the Facebook group. And then we do have a Facebook page as well. The Facebook group, we post daily tips, tricks, and knowledge and everything on the financial end, on the tax end. So be sure to follow Sipping Wealth, cash flows, tax strategy, something along those lines. All right, y'all. So thank you so much for joining me once more for this awesome live. And I will see y'all next week for another episode of Sipping Wealth Live. Our topic is... Wait, I got you. Okay. Our next topic next week is going to be essential tax tips for small business owners. So I'm directing it directly to small business owners. This was more of a general tax strategy for everyone, tax business owners and individuals. But next week, I'm going to be talking specifically to my business owners and giving you tax tips on there. All right, y'all. Have a great, amazing, wonderful rest of your day. And let's wealth up.